Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Deckers Outdoor Corporation quarterly report. Deckers Outdoor Corporation offers a diverse range of products and services across various brands. The company's portfolio includes footwear, apparel, and accessories under the UGG brand name, which caters to casual lifestyle use and high-performance activities. In addition to UGG, Deckers also operates under other notable brands such as HOKA, Teva, Koolaburra, and AHNU. These brands offer a wide variety of products, including premium footwear, running shoes, trail hiking boots, fitness apparel, sandals, shoes, and boots. The company sells its products through various channels, including domestic and international retailers, international distributors, and direct-to-consumer sales through e-commerce websites and retail stores. This multi-channel approach allows Deckers to reach a broad customer base and cater to different market segments. Overall, the company's product offerings and distribution channels demonstrate its commitment to providing high-quality products and convenient shopping experiences for customers worldwide. Deckers Outdoor Corp's stock price has experienced a significant drop of over 34.3% in the past year, with declines reported between 48% and 53% year-to-date as of January 2026. Several news events have contributed to this decline. One major factor was the company's fiscal third quarter 2025 earnings report, which led to a 21.4% pullback in February 2025 despite beating estimates and raising guidance. Investors were concerned about the implications of the company's guidance for the upcoming fiscal fourth quarter, suggesting a slowdown. Throughout 2025, Deckers Outdoor faced challenges due to disappointing guidance early in the year, ongoing headwinds related to tariffs, and slowing growth over the course of the year. These factors combined to make Deckers one of the worst performers on the S&P 500 in 2025. The stock's decline continued with a more than 10% fall after the company reported its fiscal second quarter 2026 earnings. Despite exceeding EPS and revenue estimates, management issued conservative full-year guidance citing tariff pressures and potential consumer pullback. Analysts downgraded Deckers Outdoor to a sell rating from Goldman Sachs, further contributing to the stock's decline. Weaker U.S. consumer spending was also noted, with domestic sales rising only 1.7% in the second quarter, compared to international sales, which jumped 29.3%. These factors have all contributed to the significant drop in Deckers Outdoor Corp's stock price over the past year. Deckers Outdoor Corporation market capitalization of $17 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Deckers Outdoor Corporation holds a significant advantage in their industry. Deckers Outdoor Corporation trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 6.26 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of various segments within a company's financial performance. On the growth side, the HOKA and UGG brand net sales have been significant contributors, with increases of 16.3% and 8%, respectively. The wholesale channel has also seen a notable increase of 13.8%. Furthermore, international net sales have surged by 27.1%, while direct-to-consumer revenue has grown by 8%. In contrast, the primary drivers of revenue decline are largely attributed to the other brands segment, which has experienced significant decreases of 33.3% and 44.7%. The phase-out of standalone operations for the Koolaburra brand has also contributed to this decline. Additionally, a decrease in income from operations for the other brands segment has further exacerbated the revenue decline. These factors highlight the importance of monitoring and addressing underperforming segments to maintain overall revenue growth. Net income and profit margins. A shift in trends. The net income of a company has shown an upward trend, with significant increases observed in the 3 months ended December 31, 2025, and 9 months ended December 31, 2025. The net income increased by $139,203, $115,625, and $73,820 respectively, indicating a substantial growth. However, profit margins have experienced a mixed trend. The gross profit margin decreased to 59.8% in 2025 from 60.6% in 2024, while the operating profit margin increased to 44.1% in 2025 from 43.2% in 2024. This indicates that despite an increase in net income, the company's ability to retain profits has decreased. A closer look at the performance of individual brands reveals a more nuanced picture. The HOKA brand saw a significant increase in net income from operations, but its segment operating margin decreased by 0.8%. In contrast, the UGG brand experienced relatively stable net income from operations, but its segment operating margin decreased by 1.9%. The overall profit margins have shown a decline, with gross margin decreasing to 57.7% and operating profit margin remaining flat at 25.4%. The net income margin also decreased by 0.2%. These changes suggest that while the company's net income has increased, its ability to retain profits and maintain profitability has been impacted. The decrease in total other comprehensive loss is cited as a reason for the improvement in profit margins. However, this positive trend is offset by the decline in gross margin and operating profit margin. The mixed performance of individual brands further highlights the complexity of the company's financial situation. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from page 14 and page 42 reveals that in both 2025 and 2024, the net cash provided by operating activities was substantial. In 2025, it stood at $1,086,113, while in 2024, it reached $1,117,515. This trend suggests a stable financial position for the company, with sufficient funds being generated from its core operations to support its growth and development. The company's debt level has undergone a notable shift over the past year. Initially, it was reported that the debt level had increased significantly, page 14. However, upon closer inspection, there is evidence of a slight decrease in debt from $32,390 to $38,183, page 21. This change may seem counterintuitive at first glance, but it suggests that while the company's debt has not decreased as much as one might expect, it has still shown some improvement. In terms of interest expenses, there is a clear indication of a decrease. According to the data, total interest expenses dropped by $267, minus 9.6% decrease, in 2025 compared to 2024, page 5. This reduction in interest expenses is a positive sign for the company's financial health and suggests that it may be able to manage its debt more effectively over time. The recent market analysis reveals a mixed performance across various segments of the industry. On the positive side, two notable brands have stood out for their exceptional performance, UGG and HOKA. These brands have demonstrated strong sales and customer loyalty, indicating a high level of satisfaction among consumers. In contrast, other brands in the industry have struggled to keep pace with these top performers. The other brands segment has underperformed significantly, suggesting that these companies may need to reassess their marketing strategies or product offerings to regain market share. Management is optimistic about the company's outlook, with a focus on expansion and growth. Key strategies include increasing brand presence through marketing efforts for UGG and HOKA brands, expanding product offerings, and investing in global brand awareness. The company also plans to increase sales through various channels, including wholesale and direct-to-consumer (DTC), while expanding internationally. In addition to these initiatives, management is prioritizing talent acquisition and retention by increasing headcount in key markets. This investment in human capital is expected to drive growth and support the company's expansion efforts. Furthermore, the company aims to maintain a strong brand presence across various markets, positioning itself for long-term success. Management also highlighted its commitment to repatriating earnings from non-US subsidiaries, with plans to continue evaluating and adjusting this strategy as needed. Overall, the company's outlook is one of growth and expansion, driven by strategic investments in marketing, talent acquisition, and international expansion. The company's financial strategy involves buying back its own shares. This is evident from the implementation of a stock repurchase program. According to the provided information, in 2025 alone, the company repurchased a total of 8,019,067 shares worth $813,488. Furthermore, the company has a history of share buybacks, with an additional 3,773,471 shares being repurchased as confirmed on page 46. This indicates that the company is actively reducing its outstanding share count through this program. Concerns about inventory buildup or supply chain disruption are indeed present in the current situation. One major concern is supply chain disruption, which is affecting various parts of the logistics process, including owned warehouses and distribution centers, wholesale partners, 3PLs, and third-party carriers. The issue of inventory buildup is also a pressing concern. Inventory levels tend to build up during certain quarters to support higher selling seasons, leading to potential overstocking issues. Furthermore, the company has entered into a non-cancelable minimum commitment for 3PL services, which may exacerbate these concerns. Additionally, the decision to make earlier and more costly purchases of inventory in anticipation of elevated demand may also contribute to inventory buildup worries. That concludes the financial summary for Deckers Outdoor Corporation. Feel free to comment below, and I will be happy to answer them when possible.